Nice and Arista Networks are two exciting growth stocks that investors are asking me about lately. They're asking me which one I think makes a better investment for long-term buyers. So in this video, I'll give you my answer. I'll compare these two across several critically important financial metrics, including revenue growth, operating profit margin, and return on invested capital. Then I'll look at valuation. I'll share with you my calculations on what I calculated for a fair value for these two stocks. And we'll also look at valuation on a forward price to earnings basis to get another perspective. And then I'll give you my conclusion on which one I think makes the better investment. So that's a lot to cover in a short video. So let's get right into it after a brief message from my sponsor.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
So I wanted to start with the revenue growth comparison going back to 2015. And Nice and ANET started their revenue around the same level in 2015 with around 900 to 800 million in revenue. Arista Networks since then has grown its revenue much quicker than Nice, increasing to 8 billion in trailing 12-month revenue, most of that coming since 2020. That's good for a compounded annual growth rate of 26.7%, which is more than double the compounded annual growth rate of Nice in that time of 12.5%. Perhaps more impressively is Arista Networks' improvement in operating profit margin in that same time. So not only did it more than double the revenue growth rate of Nice, it also expanded its lead in terms of the operating profit margin. Again, they started around the same levels in 2015, around 17.8%. And Arista Networks expanded its operating margin to over 43% in that time. An excellent improvement in margin, but also an excellent number in margin. Those are two different things. You like when a business has a great operating profit margin, but you also like when the business has been improving its operating profit margin. Arista Networks has been doing both. Meanwhile, Nice has been more volatile in its operating profitability, but still has demonstrated improvement over the previous decade, increasing from 18% up to 21.2%. Again, a less than half than what Arista Networks is demonstrating. So far, the two metrics we looked at, Arista Networks has more than doubled that of Nice, and those are positives. These are numbers that you want to have larger comparatively speaking. The next metric I wanted to compare these two on is return on invested capital. And in this regard, we're seeing a couple of different things now. Whereas in the previous two metrics, we saw Arista Networks both having the better number and the better trend. In this metric, which in my opinion is the most important metric, Arista Networks has the better number by far, but doesn't have the better trend. In fact, its trend is worsening meaningfully from 93% in 2018 down to 51%. An ROIC of 51% is incredible. It's among the best of the best in business worldwide. But the trend is a little bit alarming. Nice has improved its trend from 6.9% in 2018 up to 14.5%. An ROIC of 14.5% is solid. It depends on your weighted average cost of capital. The general rule of thumb I like to consider is an ROIC that's greater than the WACC, weighted average cost of capital. And I'll share with you these companies' weighted average cost of capital in the next slides when we look at valuation. So Arista Networks boasts a weighted average cost of capital of 12.75%. And if we look at Arista Networks' ROIC of 51%, you'll see it has a 4-to-1, over 4-to-1 ratio ROIC to WACC. That's a great ratio. That's among the best of the best. Meanwhile, the fair value calculation for Arista Networks, I calculated the fair value of this business at $83. The current market price is $143. So even after accounting for a margin of safety, this stock looks slightly overvalued when using my discounted cash flow valuation approach. Meanwhile, Nice boasts a weighted average cost of capital of just 9.52%, and I calculated its intrinsic value at $277 compared to the current market price of $141. This stock looks significantly undervalued when using my discounted cash flow valuation approach. What's more, if you compare the weighted average cost of capital of 9.5% to the ROIC of 14.5%, the company has a roughly 1.5 to 1 ratio of ROIC to WACC, which is okay. It's not great. It's not as good as Arista Networks, but it's okay. Lastly, I like to look at valuation on a forward price to earnings basis, and Arista Networks is trading at a forward price to earnings of 48 compared to Nice, which is trading at a forward price to earnings of 11. That being said, I do believe Arista Networks deserves a premium valuation. Its revenue growth rate is more than double that of Nice. Its operating profit margin is improving and more than double that of Nice. Its ROIC is above 50% and boasts a 4 to 1 ROIC to WACC ratio. So a forward PE of 48 looks, I would say, undervalued for a business of this quality and these levels of metrics improvement. Meanwhile, Nice, trading at a forward PE of 11, also looks undervalued for a business that's grown its revenue by double digits, is improving its operating profit margin, improving its ROIC, and boasts a ROIC above its weighted average cost of capital. So I like both of these stocks. I have them both rated as a buy. But if I had to pick just one of them to buy today, I would pick Nice as the better investment given the current market prices. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.